Okay, welcome everybody. Stacy Alcorn here from Layer Realty. Thank you for joining us today for our 1031 exchange program. Today we have with us an absolute expert in 1031 exchanges. I want to welcome today Lynne Bagby. Lynne has participated in literally thousands of 1031 exchanges as a qualified intermediary. She's been doing this since 2000. She has presented several classes over the years for our agents. And what you will find in the next hour is there is so much content, so much information. You want to make sure you have your computer, that you're typing notes, or that you have pen and paper, because she just spends an hour straight giving you tons of content that you can use for your business. So with that, I want to welcome Lynne. Thank you for joining us once again, Lynne.
Oh, Stacy, thank you so much. I really appreciate the opportunity. Your group is one that I really enjoy speaking with, and I've had the privilege of working with many of your agents over the years. So it's always a treat when you say, hey, do you want to do a 1031 exchange class? Always glad to participate. Sergio, thank you for being behind the scenes for us this morning, because I am not a tech guru. I have a very limited capacity, and between you and Stacy, I might need you. So with that said, before we get started, everybody, thank you for attending today. And I hope you'll find this tool useful as it pertains to your real estate transactions. Not all real estate is someone's primary residence. A good portion of the real estate in Massachusetts is investment property. So whenever anyone's selling real estate, because real estate's an asset, there is a capital gain component on a sale. Now, we're going to talk about the 121 exclusion, but I'm going to be talking in numbers today because I want you to familiarize yourself with these numbers. Section 121 is the primary residence exclusion, and we'll cover that later. 1031, and that's for the exclusion for your primary, provided you meet the qualifications. The other is 1031 for investment real estate. We'll cover what different types of like-kind property are. Like-kind meaning what kind of properties within the real estate category are able to be exchanged. You are going to find that I'm somewhat repetitive, but it's only because I need to be to make sure that we're on the same page. This is not a tax code you should assume, because everyone's transaction is like a snowflake. Two of the other items we're going to cover today is what's the difference between a second home and a qualifying vacation property, which allows for some minimal use time, keyword minimal. And then also my favorite, the split treatment transaction. What's that? Think of an owner-occupied multifamily. One unit the taxpayers live in, the other unit or two has been held and reported as for rental income. What happens upon that sale? Potential use of two tax codes, and then it would be done by percentage. So we're going to cover that today as well. So I think the one last layer transaction I did involve the split treatment transaction. Tomorrow, I'll remember who the agent was. It won't happen today. So my recall's just not there. So let's get started. Stacy kind of gave you an intro about me. One of the things that you might want to know is the fact that I have been working exclusively in this marketplace for the last 20 years, since 2000. So I'm very familiar with different aspects of all of the New England states, although my clients have properties literally everywhere. So sometimes they're working for the government, living out of the country, and they're still buying and selling their United States property because they are a U.S. citizen. So we've got great materials. Sometimes you might have a client who is selling in another state and they want to buy here. You find out they want to exchange. I can still handle their transaction. Some states have different withholding requirements and things like that. So we can be a resource for lots of information pertaining to Section 1031. So I'm always available, for a conversation. It's important that you know that the qualified intermediary industry is not regulated. So I speak to you from the position of the qualified intermediary firm I represent, which is Asset Preservation, Inc. We've been around about almost, I've lost count. I remember when we had our 25th anniversary. I think we might be close to 30 years now. We are a wholly owned subsidiary of Stewart Title, which is a national title insurer that's been around for 127 years. So that's very important. We're very, very well financially backed, a lot of strength and integrity. So that's the point. The QI industry is not regulated. You need to know who the QI is. that your clients are dealing with. So the rest of it you can read on your own. I'd rather spend time talking about the tax code. Section 1031 says this, and realize that this tax code started, it was first codified in 1921. So it's over 100 years old. So when you hear they're going to take it away or this or that, they've been trying for years because the government looks at it as a money grab. But when they realize and they're educated and they see what a terrible effect would have on the economy, it actually would, because realize when people hold investment property, 1031 is not a tax loophole. It is there because it allows an investor, someone that wants to be invested in real estate, to either provide housing, whether it's short-term or long-term for someone, or it provides place for people to work. So this is an investment property tax code. So people need places to work. So think of a Walmart, think of a law office, think of your Lair Realty offices. So that's what people are doing when they're invested in real estate. They're either providing housing or they're providing some type of building for people to work in. And anyone that's a taxpayer can use this tax code, from the individual investor or to a big corporation. Think of in housing like Avalon Communities. You see the Avalon apartment complexes everywhere. So from the very small investor to the large corporate investor, same tax code. So what does it say? No gain or loss shall be recognized on the exchange of real property. You might want to make a note. Real property means real estate held for productive use in trade or business. What does that mean? Collecting rental income, whether it's residential, commercial, or mixed use. Mixed use meaning maybe there's a laundromat on the bottom and a couple of apartments on the top, or trade or business. You can run your own business out of it. So think of a dry cleaner that might own his building. You'd be able to exchange that building and go buy something else. Or for investment, raw unimproved land. So if you have raw unimproved land that you've held for appreciation, that would fit the qualifications of held for investment. If such real property is exchanged solely for real property of like kind, again, the asset class. So it doesn't have to be a condo for a condo. It can be a condo, an expensive condo for a retail plaza, if you want, which is to be held either for productive use in a trade or business or for investment. So it's investment property to investment property. Now, this tax code was changed during Tax Cuts and Jobs Act. There used to be other business property by asset class, like a commercial restaurant equipment. It would be a commercial oven for a commercial oven. Rental car companies could exchange their cars to get new fleets, but that was taken away in Tax Cuts and Jobs Act. They've gone to 100% expensing on those items, at least until any of those limitations sunset. But for now, just know it's only real estate that can be exchanged under Section 1031. What doesn't qualify? This is important, and make a note of the very first one. Stock and trade or other property held primarily for sale does not qualify. So what does that mean? Developers who buy a chunk of dirt, build a house and sell it, that's property held for sale. Even if it took them 2 years to build the house. They bought a chunk of dirt, they build a house, they're selling it. That's property held for sale. They would get taxed at their ordinary income tax rates or their business tax rates. What about that rehabber? They go buy a rundown building, they renovate it and sell it, property held for sale. Now, if either of those same people, the developer or the property rehabber flipper, chose to build the property, build the house, rent it out for a while, rehabber bought a distressed building, fixed it up, held it out for rental income for a while, then after they decide to stop renting it out, they could then do a 1031 exchange. It's the immediacy of the sale after the construction is complete that might determine that it's property held for sale. Stocks, bonds, and notes. So when you own stocks, bonds, or notes, you're a shareholder in a corporation, you're a bond holder, or you're a note holder. That does not qualify. This is why REITs do not qualify. A REIT is a real estate investment trust. It's a corporation. The REIT itself can do 1031 exchanges within the REIT and the shareholders get dividends, but you cannot sell investment property in a 1031 and buy into a REIT. There are other passive income investment properties for that. We get to the like-kind exchange page, I'll tell you what that is. Other securities or evidences of indebtedness or interest. So you cannot sell your investment property or go pay off a mortgage on another one or your primary residence. That would be selling real estate, trying to use 1031 to pay off a debt on another property. Nope, nope, nope. Okay, interest in a partnership. Many times I'll have people, an individual taxpayer, say, I'm selling my property and I want to invest with into a property that another group of people own in a business entity, like an LLC or a corporation or some of these syndicated deals. Does not work. When you have LLCs or partnership agreements in place or a corporation, those business entities own the property, not the people, not the members of the shareholders. The business entity owns it. So you cannot sell something that you've been reporting individually and go buy into that business entity. That business entity could sell you a chunk of the property. So you would, the taxpayer would be the taxpayer and that business entity. The taxpayer might have a percentage of ownership interest in the real estate, and the business entity would have their own percentage, reporting income and expenses accordingly. It's the only way it can be done. You cannot sell because there can be no change in tax ownership from the relinquished property sale to the replacement property purchase, same taxpayer. We'll talk about that shortly. Certificates of trust or beneficial interest. This is the same for trust, specifically irrevocable ones. It's sort of like the same as the interest in a partnership. If you have a trust that is the taxpayer, as opposed to a pass-through where the individual beneficiaries or the trustee is the actual taxpayer, so the trust is disregarded for tax purposes. And that the irrevocable kind, you cannot break that apart because the trust is the title, the taxpayer and title holder in that case, and you cannot buy into it, sell as an individual and buy into a trust, or sell out of one individually either, because the trust is the taxpayer. A chosen action, if you're awarded an award to a lawsuit, it is not exchangeable. Okay, so that's what doesn't qualify. So let's take a look. So we talked about there's a capital gains tax due when you sell real estate, or under Section 121 primary residence exclusion, you get a certain amount of exclusion on the capital gain, and then therefore the tax is due. So what happens when you sell a piece of investment real estate? Many people call me and they go, oh, don't I just owe 15%? Again, nope, nope, nope. There are 4 taxes that go into capital gains taxation on real estate. There's a depreciation recapture tax. Time to make a note. Residential real estate, your single to 4s, have a depreciation recapture at 25%, or depreciation at 27.5 years. Commercial property at 39. Again, if it's a mixed use, you might have the laundromat on the bottom being depreciated at 39, but those 2 apartments on the top at 27.5. That is a question for an accountant as to how they've recorded that, not the qualified intermediary. Please note, in our role as a qualified intermediary, we're not permitted to provide tax or legal advice or compute people's capital gains taxes for them. That's up there. We're part of the equation in this transaction, not the advisor. I can provide the Treasury guidance and how the exchange works. So you've got it. So if you've taken, say you've had an investment property for 10 years, realize that land is not depreciable, just the building. So I would have your client go and find out from their accountant how much depreciation they have, so that they'll know, well, this is the value. It would get taxed at 25% and is able to be deferred in a 1031 exchange. Federal capital gains taxes are either 15 or 20. Here are your 2022 thresholds. Okay, so anybody who is under 459, 750 as a married couple are in the 20, or would be in the if they're over that, they'd be in the 20. If you're married filing jointly, 517.2 and over would be in the 20 as well. Anything under that is in the lower price bracket. 3.8%, this net investment income tax is part of the Affordable Care Act. So we still have that for our healthcare system. So this was in part of the bill that nobody really realized, I think, until about a year later. But just so that you know, this is on passive income. So if you're a single filer And your passive investment income is anything you did not earn a W-2 or 1099 for is going to be in this category. So just the capital gain from the sale would apply. Any rental income you've collected, any stock, bond, and note sales where you've recognized the, where you recognize the income. Let's see, just anything that you didn't earn a wage for, but it's going to show up on your tax return, this tax will apply. For most people here now, still with the high appreciation still in our real estate from the times that people purchased it, just the capital gain alone would have this apply. And then you have the state capital gains tax at 5.1. Okay, so all those 4 taxes weigh into how much you have to pay. If you were to cobble these all together and someone's owned their property for quite a bit of time, usually I say if the net investment income tax is going to apply, they would be paying anywhere between 25 to 28.8% of their capital gain. That would be about the percentage if you cobbled them all together. So, but for most accurate information, they want to check with their accountant and have them run the numbers. Okay. Exchange entities. So what does that mean? It's how you hold it's how you hold title to the property and who has the tax ownership. Again, tax ownership is what needs to stay constant. We live in a non-community property state. Out of all of our 50 states, there are 41 non-community property states. So legally married spouses are viewed as individual tax owners. Whereas in the 9 community property states, and there's none on the East Coast, they're all, I think they go from Texas over, right? There's 9 that are community property states. If I've got 2 legally married spouses on a deed, they're viewed as 1 taxable unit. So in this case, if they're showing the wife sells, the wife acquires. So if I have just the one spouse come to me, and they're the ones on the deed, and I find out they're married, my question to them is, you need to ask it, and they say, I want to add my spouse when I buy the replacement property. There's a whole conversation I need to have with that they need to have with their accountant to determine a few things first. So this is not going to be your responsibility to get involved in this, but many of you may own real estate. Just realize that it's best to keep the same title holder matches the taxpayer. Okay, that the taxpayer and the deed of record match. That's the important thing here. Smith LLC sells, Smith LLC acquires. Here's why. We're going to assume that Smith LLC is regarded for tax purposes, meaning that there's more than one member, or it is not, or it's taking a corporate tax election. If this LLC sells, the same one acquires because it's a regarded entity for tax purposes. The entity owns the property, not the members. So when you see Smith LLC sell, say there's 3 members, and member A says, hey, they're selling this property and I want to do a 1031 exchange, it doesn't really work that way. There is maybe a mechanism to work around it. We have information on that. But just for the purposes of you being out there, just know if you've got a regarded business entity selling, the regarded entity needs to buy, and your direction should be, and you hear that somebody wants to go on their merry way, you need to talk to a qualified intermediary and your accountant as well. We have information for some of the workarounds that might work, and I'd be glad to give it to them to go talk to their accountant. So this is not something you need to get involved in as an agent. It's very complicated. It's not your fiduciary responsibility, and you're not permitted to give tax or legal advice either. So be very careful with this. The lights that go off would be listing a property and somebody says, well, there are 3 of us that own it in an LLC. Know that if there's more than one person in an LLC, it's a regarded entity for tax purposes. And so therefore, if they want to make changes, they need to go talk to a qualified intermediary and their accountant ASAP. Okay, because having more time to prepare is better than less time. A corporation sells, a corporation acquires, same reason. It's a regarded entity for tax purposes. Durst partnership sells, Durst partnership acquires, same reason, regarded entity for tax purposes. However, having the same vesting or how you hold title is only a guideline. The key issue is who is the taxpayer? So this is how I spend my day, is finding out who my taxpayer is, a good portion of it anyway. So here's what's important. It's necessary to distinguish between federal tax ownership, state law ownership, and vesting. So I'm going to cut to the chase. Federal tax ownership, basically, when you have a regarded entity, that's a federal TIN or EIN number, okay? State law ownership, again, we talked about community and non-community property states, where you've got legally married spouses that in the community property states are viewed as one taxable unit, whereas even though in a non-community property state, legally married spouses may be married filing jointly, they're still considered individual taxpayers as well. So I need to know the tax reporting history because there could be a workaround in some cases, but not all. So again, not your way to jump in. Get it over to the QI who has information that they can supply so that they can go talk to their accountant about it. It's kind of like doing your online research before you go to the doctor. You want to know if you have a brain tumor or you just have a lump where you hit your head, right? So check out all the possibilities. All right, and then vesting, how you hold title to the property. So in a situation where a taxpayer who has been a disregarded entity for federal tax purposes could be a single member LLC, okay? So they can sell, so anybody who is like the actual tax owner reporting under their social 1040 and filing a Schedule E can sell in their name. Oh, something just fell in my office. Sorry about that. I knew when I put that file bin up there that it was precarious and it just fell. Sorry about that. So they can sell as an individual taxpayer and buy as a single member LLC. Here's why. They would, even though they're issued a federal TIN, they're not going to use it when they report income and expenses. They're going to continue to use their social 1040 and a Schedule E, which they were doing before when they were themselves as an individual. They're still going to continue the same tax ownership. The only time that you could have two members in an LLC and take advantage of it being disregarded is if for the sole purpose where there's two people, one person is the managing member, they may own 98 or 99% of the business entity. And the only reason the other person has 1 or 2% is to keep a bankruptcy remote. A bank might require this. And that person has 1 or 2% member has no management responsibilities and no benefit, financial benefit or interest in the property whatsoever. It's a specific situation. You're not going to be involved in this too much. If you happen to see somebody goes, oh, I own this property in an LLC, you may say, is there one or more people in there? Because you could have some tax complications depending on how you've been reporting your taxes and moving forward. You need to talk to the qualified intermediary and your accountant, because all I know about 1031 is that you have to have the same tax owners from one sale to the next. I mean, even if you want to get involved in that far, you don't want to get too deep in there and you don't want to start answering questions. You can just see from this conversation, which is the reason I bring it up, that it's a multi-level. I dissect it more without giving tax and legal advice, but I will give them printed materials to take to their accountant and a series of questions to ask. So, and then sometimes I need to have a conversation. Don't worry too much if this is just, your individual selling or married couple selling, a married couple's buying. If it, that's no issue at all. When there's entities, we need to have a discussion. All right, so I'm going to preface this related party section by saying the IRS only likes your family a little bit. They don't love them like you do. When you're dealing with family members in 1031 exchanges, the IRS will allow some circumstances, but others they won't. So in a 1031 exchange, there can be issues when dealing with related parties and sales and purchases. And who's a related party? Section 267B of the tax code will give you the complete list. I'm only going to deal with the most prevalent ones. These are the top two, the top two that happen most of the time. The rest all pertain to grantors, beneficiaries, and fiduciaries of trust, and they have all kinds of combinations. So it's a tongue twister, and you got to do a lot of research on them. So we're not going to deal with that today. We're going to just deal with this. So if you've got a taxpayer, who would their related party be? Their brothers or sisters, either by whole or half blood, spouses, ancestors, meaning their grandparents, lineal descendants, meaning their children. In-laws are not considered members of the seller's family, nor are aunts, uncles, cousins, or ex-spouses. Those are not related parties. The first group is they're all at the top. Entity ownership to be more than 50% of direct or indirect ownership. A corporation controlled by a trust for the benefit of the taxpayer is also related. So in a situation like this, I have someone who is selling a property, say a taxpayer who's selling individually, but he and his brother own another property in an LLC. Can he sell his property himself and buy from that business entity that owns the property? No, because even though the business entity is regarded for tax purposes, he's indirectly related to his brother through it because his brother's his brother, and then he also owns the property. So it's a 100% related party transaction. The only way that they would be able to do it is if that business entity is able to do a successful 1031 exchange themselves. And most time that's not what the members want to do. So they're looking to do something else. So these get tricky. Again, you're going to involve the QI, and just I don't even know that your conversations in regular life are going to get down to this level. Let me just stop here and say, when you have property, you see its investment, your role might be to say, hey, have you considered a 1031 exchange? Because there may be a way you're going to be able to defer the some or all the capital gains taxes on the sale when you buy other investment property, any type of investment real estate anywhere in the country. And maybe you want to leave it there. Sometimes you may know these people and they're going to start talking to you about this stuff, which is why I spend time talking about it, because I don't want you to be like a deer in the headlights. I also don't want you getting down into the weeds. So kind of figure out your 30-second elevator speech as to how you're going to handle it when people start, going down a road that you don't really want to be involved in. All right, so there's 4 different ways to deal with related parties. Let's say, Stacy, because I can see you, let's say Stacy and I were sisters and we wanted to swap investment property. We are able to do that. We could trade our investment real estate. Stacy has a real estate office. I have like a retail condo that I've been running a business out of. But Stacy happens to like the plaza that I'm in, and the one office that she might want to exchange because she owns the building is out in the boondocks, and they've been redeveloping, and I don't know, she just wants to get into another area, and the area that my retail condo is in is a desirable location because a lot of the different things that they're doing in the area. So she approaches me and says, hey, Lynn, as my sister, can we swap properties? Well, there's a couple more things that come into play here, but let's just say that our accountants say this would work because the numbers match up and everything. We decide to trade. Stacy has to hold on to my property for 2 years. She can she doesn't have to keep my pet grooming salon. She can run her real estate office out of it. I am going to go because I want to have another business. So I'm going to take her space because this new business idea I have is perfect for that location. So we can swap properties. But because we're sisters, she has to hold on to my property for 2 years and I have to hold on to hers for 2 years. We can't move into it. We can't sell it. We can't do another 1031 exchange. There's a 2-year hold. Now, again, Stacy and I are sisters. I want to sell my investment property to her. I just want to sell it to her. Let's just say she's not in business. It's not whatever. She can do with my property whatever she wants. But whatever I buy, I've got to hold on to for 2 years. Buying from a related party, this is where the water gets muddy, and it's kind of like quicksandy. All right. Stacy and I are sisters. I'm selling my property to somebody else, but I want to buy my property. I want to buy her property. The only kind of property I could buy from my sister would be investment property, because she has to be able to do a 1031 exchange as well, and it must be successful for mine to work. What I cannot do is buy my sister Stacy's house, her primary residence, even if I'm going to use it for rental, because she's going to realize cash at the end. So, or she's going to have cash at the end, or be taking advantage of another tax code. So in order for my exchange to sell my investment property to somebody, do a 1031 exchange and buy her property as my replacement property, it has to be investment, because Stacy needs to be able to do a successful 1031 exchange also. She just can't set it up. Now, look at your screen. It'll say Revenue Ruling 2002-83. This went into effect in the year 2002, the 83. I don't know, it's maybe they were deciding on 83 things that day. Who knows? But Revenue Ruling, the IRS calls them safe harbors. They're the rules that apply to everybody. All right. And it was based on a private letter ruling. Private letter ruling was done in for a specific case that the IRS ruled on. And those never have years. But if you see a revenue ruling, that's the year it came out. Now, again, purchasing from a related party who is also exchanging, that goes through the procedure on the private letter ruling. It supports item number 3. So just beware when you hear people say that they're going to sell their property, but they're planning to buy their brother's property. You just need to say, you need to get in touch with a qualified intermediary. What I know is that there are some rules when it comes to buying from a relative. Bingo, that's it. Don't yes or no, you can't or can't do that. You should or shouldn't do that. All you know is that there's some rules regarding buying property from relatives. Okay, you can use my phrase. The IRS only likes your family members a little bit. So that and that should help you out with that. Get it to a QI right away, provide information, get to the bottom of it, and help your client have questions to ask their own accountant. Okay, so some topics on like-kind property. I don't like the word issues. That always makes it seem negative. I'm going to change this to topics, I think. So what doesn't qualify under 1031? Your primary residence. If you've lived there, again, we'll go over it when we do the split treatment section. Your primary residence, you're able to take that primary residence exclusion most times, but what some people will do is they'll call me because they've only lived in their primary for a year and they want to sell it. And they think, well, I can, because I can't use 121, I haven't lived there 2 years out of 5, then I'll do a 1031 exchange. Nope, doesn't work. You cannot, it's not a default. This is only for investment property, section 1031. And then again, property held for sale or dealer property does not qualify. The qualifying property was defined in when I described the tax code. And then here are some of the asset classes that are cool. Air rights. Let me tell you real quick. So I had a guy call me who he's a Mass resident, but he has had a commercial building in Brooklyn, New York that he'd owned for 5 years. He sold the air rights above it for $300,000. And then he purchased a multifamily property in Jamaica Plain for $750,000. So that was a successful exchange because he was holding that out for rental income. Perpetual communications easements. An example would be cell towers. Those are exchangeable. Oil, mineral, and gas rights. Leasehold interests of 30 years or more. Fractional ownership interests, and this is what I wanted to speak to you about, was like a Delaware statutory trust, because those types of properties are passive income investment producing properties. Many times people will buy them because they have not purchased enough property for a full deferral and they don't want to pay taxes on the difference. So they'll buy a DST, Delaware Statutory Trust, as to reinvest the remaining gain. Or you sometimes have people that are ready to retire. They don't want to manage properties anymore. These are institutional grade properties sold through registered reps because they're governed by the SEC. The investor actually has a deeded percentage of ownership through the DST. The Delaware Statutory Trust is a disregarded trust for tax purposes. It's merely the title holder. The investors, the beneficial investors, all have an interest in the underlying real estate. You need to make a note. In order to be able to purchase into a DST property, you need to have a net worth of $1 million or more, excluding your house. So your 401k, your SEP, your IRA account, your savings accounts, Anything that's an asset that's not your primary residence can bring you up to that $1 million threshold. So I do have a list of registered reps I've been working with for years. You need to know if you call me because your client says, listen, I'd like to sell this, but I don't want to pay the taxes. And you see that they're getting close to retirement or they're retired. Any referrals that I give, I do not ask for, nor will I accept or receive any type of financial compensation, new car, trip, bonus, commission, nothing. It's merely a matter of customer service. That's it. I don't want to be in that lane. So I don't want anyone to ever think. I just don't think that it's ethically responsible, but it's not disallowed. I just don't participate, and you need to know that. Qualifying vacation homes we're going to talk about next, because there's a difference between a second home, even if you collect a little rental income from it, and a qualifying vacation property. So there are quite a variety, and these properties you can purchase anywhere in the country, as long as, again, you're holding them from rental income, running a business out of it, or holding for appreciation like a chunk of raw unimproved land. Okay, so that's a detailed description of like-kind property. So what is a qualifying vacation home? Revenue procedure, what year, everybody? I can't hear you, but it came out in 2008. So it creates a safe harbor, or creates the guidelines for vacation home exchanges, and the IRS will consider that this dwelling unit was held for investment if these requirements are met. Number one, either prior to a sale, or when you're selling it as relinquished property, or if you're purchasing it as replacement property. There's a 24-month period that's looked at. So if you have a client who's selling a property at the Cape, and they say, I've owned this property for 5 years, my question is, what's been going on for at least the last 24 months? Because that 24 months is divided into 2 12-month periods. The property must have been rented for a minimum of 14 days for each of the 2 12-month periods at the minimum. Most people have rented it more because they want to make money. But a minimum of 14 days, that does not have to be consecutive days. It could be 7 weekends, right? Or it could be a week and all the rest were weekends. Minimum of 14 days, each of the 2 12-month periods. The rest of the time would have been available for rent. And the taxpayer gets 14 days, each of the 2 12-month periods for personal use time. The IRS does not like your family. So if you rent to family members, you've got to be collecting fair market rent. Now you're also going to see at the bottom that they get 14 days or 10% of the time it's rented. So let me give you a scenario. Let's just say person owned the property for several years, and at least the last 24 months, the 2 12-month periods. The prior tax year, they rented it for 30 days only. It was available for rent, and they got 14 days to use it. They used it for 14 days. Let's just say the second 12-month period, they had a longer term tenant and they rented it for 180 days for 6 months, right? They'd get 18 days to use it personally in that case. I've got a lady down in Newport that rents to Salve Regina, somebody there, and they rent it for 300 days. So she gets to use it 30. Now that's not a rough gig, right? So she gets 30 days of personal use time because somebody's renting it from her for 300. So these are things that I need to go through with people, because many times they'll call me up and they have a property at the Cape, and these are things I need to go through. So what happens with some people is they'll say, I never rented it out. I have to, did you stay there? Well, yeah, we stayed there for a couple of months in the summer. To me, that looks like a second home. I'm going to send them vacation home guidance requirements, and I'm going to tell them, you need to go discuss this with your accountant, show them this to determine whether or not you're going to qualify under Section 1031. Because you could have somebody that has like 180 days of rental, but they've stayed there all summer. They've stayed there for several months. So that's going to make it a second home. It's that how much you're using it as personal use time makes a difference. You've got to go by the guidelines. Now, some people will say to me, well, they're going to buy a property, right? And it needs some fixing up when they first get it. So my you're going to think, well, the 24 months, starts when you buy it. Well, in the case where they've got to do some fix-up work before they're able to make it available for rent, I would say, I want you to talk to your accountant about documenting the time that you fix it up. If you're doing the work yourself, because you have, you're a construction person, what kind of documentation would they want to have? Because they're not going to expect you to drive back to Boston and then drive, then drive down to do the work. I mean, maybe you would stay there while you're fixing it up. And when would your timeline start? Most likely when it's finished and you're able to put it on the market. But these things need to be documented, especially with the 87,000 new agents we're getting, because people say, well, how will they know if we used it more? I know for a fact that they've asked people in an audit to see their electric bills. And I was told even more that they could ask for credit card receipts to see if you were in the area. Because what if you have a Cape property, it's the month of July, and there's a $500 electric bill. Month of August, you're showing 2 weeks worth of rental income and you're saying nobody stayed there. Say you've already stayed there in June, right? And you have the same $500 electric bill. That's when they start asking questions. If you're audited. So nobody needs to be scared. I just say, if you're looking to use a vacation property as a qualifying investment property and you want to have personal use time, discuss with your CPA how they want you to keep your books, how they want you to document your time. It may be more than receipts, but how they want you to document your time and what you did down there, because you fixing up that property and doing work on it should not affect your personal use time. Okay. Realize that if you do let family members stay and you're not collecting rent from them, it's viewed as your time. So again, you only get 14 days unless you go to 150 days or more of actual rental income at fair market rent, then you would start getting 15, 160, 16, 170, 17. So I know I don't want to beat a dead horse, but this is really important. Intent to hold for investment. So again, it says property held for productive use in a trade or business or for investment, but you also have an intent to hold for investment. Intent is the taxpayer's subjective intent. How long you hold a property is part of that. Now, notice that I'm going to say to you something, and then I'm going to kind of take it back because this is a lot of I before E except after C. There are no holding requirements under Section 1031. It's all about intent. But I just gave you 2 examples in a related party swap transaction. Related parties have to hold on to each other's property for 2 years if they do a related party swap. Again, if you were to buy replacement property from a related party, the other person has to be able to do a successful 1031 exchange too, and we have to each hold on to our property for 2 years before we move forward and do something else again. And then I also gave you a 24-month hold in vacation home guidance, which based on when the tax year runs could be three taxable years, which is every time we go from 12/31 to 1/1 of the new year. If you go around twice, that's both 2 calendar years and it's 2 tax years. However, what happens if you purchase a replacement property in October of 2022, it's October 31st to November 1st of 2023, and then around again to 2024, you've got 3 taxable years, right? You've got 2022, 2023, 2024. So taxable years are each time the calendar changes. Calendar years is every 12-month period. Okay, so how long must you hold a property? Well, under a year is like riding down the wrong way on, well, rush hour traffic isn't bad around here because it's like, it doesn't move, but it's like driving down a freeway at top speed on the wrong side of the freeway, right? So under a year is really difficult to achieve. Your good reason for doing an exchange in the same tax year may not be a good reason to the IRS. There could be facts and circumstances that would allow that. As a QI, be discussing this with your accountant and so with the taxpayer. In 12 months time, you can take a long-term gain. But if I've been exchanging throughout the course of my life, I probably wouldn't target after 12 months moving into my investment property. After 12 months time, I think I would go a little longer. So, and then if you were ever audited, okay, and then in the related party, you have the 2-year hold, and then in vacation home guidance, the 24 months. We also know that if the IRS audits you, they usually ask for 3 years worth of tax returns. That's usually an automatic. So all I'm going to say, before you decide to move into a former investment property after you've done a 1031 exchange, longer time's less risky. So if you buy a property, you do a 1031 exchange, you're going to exchange again. You want to take a look at those guidelines before you do it, but you may have some circumstances that would cause you to be able to do it sooner than one would think. So they do take all facts and circumstances into an account, something to be discussed. There's no rule of thumb. So let's take a look. How am I doing on time? Okay, about the delayed exchange. Let me just go to my last slide. Okay, so from the day you close the sale, that's when your timeline starts. So when, as an agent, do you want to should your client start working on a 1031 exchange? As soon as they call you to list that property, you find out it's investment, and they want to go they want to go stay invested in real estate. Good time to have the conversation with a QI, because I can look for those red flag issues, like they're thinking about changing tax ownership, like they want to add somebody to the deed, like they want to go buy property with somebody else, like they only owned the property for like 11 months. Whatever it is, there's something. Every exchange is like a snowflake. Every transaction is. So it's a good time to find issues, and some of them may be able to be resolved. So that's a good time. So let's just say you have a client, everything's good. They've talked to the QI, they've talked to their accountant, we're all good. And now they accept an offer from a buyer. That's when you want to that's the ideal time to bring a QI in. I can set up exchanges right before a sale, as long as the sale hasn't closed. It's not ideal. I've done them the day before, I've done them the morning of. Not ideal situation, but we can rescue them as long as it's before it closes. Just a good normal time is when they accept an offer when engaging them, when you find out they want to do are interested in 1031, to have the conversation. But ideally, a QI coming in when they accept an offer from a buyer is when we should start our work. So this is all going to work out. We get to Friday or Thursday tomorrow, December 1st. Closing's happening tomorrow. The QI has already prepared the documents. We've got 180 calendar days to close on replacement property that they identify by day 45. So post-closing, your client will receive an identification notice and identification rules that they will use to identify property by day 45. And we're going to get into that in a minute. So again, they've signed their documents either before or at the closing. The closing happens December 1st, 180 calendar days to close on property, and weekends and holidays count. They're going to identify on the notice that the QI provides for them, which we're the QI, post-closing. So what does that look like? So before we get there, if your client cannot find property by day 45 to identify, they can choose to not continue, don't identify, let the exchange fail. They give us a call the next business day after their 45th day, and we'll return their funds. It usually takes a day or two based on wire cutoff times. So I want to go back to before the transaction takes place. And I'm not going to spend a lot of time on this because we just have the hour. But I have materials on this that I send to clients. It's called making offers on replacement property before you sell. Can your client enter into a contract for purchase before their sale closes? Yes, they can, because it's a real estate transaction that they're using 1031 as a tax election on. So they can negotiate a contract. They can even make a down payment. They just want to set up that purchase date for after the sale closes. Now, there's no need in any offers at all or any listings to mention a 1031 exchange. This is a tax election that the taxpayers, your client, is going to take. It has nothing to do with the transaction. It's all about negotiating the sale of property and the purchase of property. And that's usually based on the money and any contingencies about the property that itself that the buyers and sellers want to work out. That's what it's about. The subject of 1031 can come in at the time of the signing of the contract because you have an accepted offer, or as an addendum prior to closing. Many times people call me, they're already under agreement, so they'll put an addendum in that they're going to do a 1031 on either the buy or the sell. That's fine. So your goal is to, like any time other time people are selling regular real estate, I need to, I'm closing my sale this day. I can close with you after that on whatever they're going to buy. You do that every single day when people are buying and selling houses. You can do that here. You just want to be sure the sale closes first before the purchase. So that said, they can have a contract for the purchase even before they get to the closing of their sale. That's fine. Ideally, they're coming into that 45th day, either closing within the 45-day period or under agreement or with an accepted offer. It is not a requirement to have an accepted offer or a signed contract in order to be able to identify, but it's better if you do. Here's why. There are no changes after day 45. So if you're looking at the timeline, your client's identified by day 45, they cannot change what they ID. So that's why it's ideal to be under agreement or have an accepted offer, because then they're pretty sure once they identify, they're going to buy it. Because if they ID and they're not under agreement or under contract, or the deal just falls through, according to the G6 restrictions as a QI, we have to hold their money until the 180th day, returning it, anything left over or all of it if they haven't closed on anything at day 181 or the next business day after. We have to hold it. We're required by the IRS. So again, your goal is to, and really it's kind of good because these people have money and they've got money in their pocket, burning a hole in it. They need to commit to something by day 45. So you're going to be pretty active looking, so will they, but hey, it's another commission if it's successful, right? They can identify more than one property. Oh, I didn't get there yet. So let's talk about the numbers first. So again, the goal in a 1031 exchange, we'll talk about how to ID. You know what? I don't think I put those slides in here. So let me just jump to it now before we do the math. All right, so there's different rules to identify under. I'm surprised if it's not in here. It might be later down the road, but let me talk about it now. The whole goal in a 1031 exchange is to identify and purchase property that's equal or greater in value than you sold for a full deferral. It's the net sales price of the property, which we're going to cover on the next slide. You can do it in a combination of one or more properties. So someone sells a property for $900,000. The allowable cost of sale, make a note here is $60,000. I'm sorry. What are those costs of sale that are allowable? Real estate commission, tax stamps, recording fees, attorney fee, and the qualified intermediary fee. Those are your 4 allowable costs of sale. So let's take a look at this because the equation has a lot of information here. They sold at $900,000. They have allowable cost of sale of $60,000. That makes their net sales price $840,000. Make a note. That's your equal to number. Equal to or greater than that net sales price for a full deferral. Okay, so ideally, to maintain their wealth in real estate, they're identifying and buying property or properties that come up to a purchase price of $840,000. Okay, so that's how you get a full deferral. So now let's go through some more math. So it's 900 minus 60 gives you a net sales price of your equal to of $840,000. Those closing costs are paid off. The value of the property is $900,000. The buyer's money is paying off the closing costs of $60,000. You get your $840,000 for your equal to number or greater. Now the mortgage is paid out of $300,000, the remaining mortgage balance. The $540,000 is what comes to asset preservation as the qualified intermediary. So then we're wiring out this $540,000 for one or more properties, depending on which ones they're going to buy. As the purchase closings comes up, there's documents on the back end. The $540,000 goes in. Now this was one purchase. They're buying for $1.2 million. They take on a mortgage of $660,000. They have satisfied Section 1031. They purchased equal or greater in value than what they sold of their net sales price. Now the next one, isn't this advancing? Okay, the next one is a little different. They sell for $900,000. All these values are the same, but they decide to buy for $700,000. So they're putting $440,000 in, and the mortgages are reduced by $40,000. They have $140,000 of boot. What is boot? Unreinvested value. So they're paying taxes on $100,000 of cash boot, $40,000 of mortgage boot. I want to stop here for a minute, because if your client came to me with this equation, they're selling for 900, they're buying for 700, I'm going to ask them, another key word, what is your tax cost basis in this property? The tax cost basis is the tax platform from which capital gain is calculated. It's also known as depreciated basis or book value, okay? So the gain is between the tax cost basis and the net sales price of the tax cost basis is, which is what they bought it for, plus capital improvements minus depreciation. So it's between that number and using the relinquished property sale, the 840, the 900 they're selling for minus those allowable costs. So the gain is between the tax cost basis and 840. So if somebody comes in and says, Lynn, my tax cost basis is $500,000, then I'm going to say, well, then that you could do a partial exchange, because let's use the fact that they're buying for 7. They would defer gain on the difference between 5 and 7, the gain and the taxes on it, and they'd be paying the capital gains taxes on the 140 in boot. But what if they say to me, Lynn, my tax cost basis is $700,000, and I'm just going to buy for $700,000. They sold for 9. There's no exchange, because if the tax cost basis is the tax platform from which capital gain is calculated, and what they're buying is the same value as their tax cost basis or below, like say 650, there's no gain to defer taxes on. The whole sale is taxable. So if this person said that to me, I'd say, are you planning to buy, in this equation here, are you planning to buy more real estate? Well, yeah, suppose they want to buy for 200,000, then they wouldn't pay taxes on this. They could buy another property. So I gave you a quick example of a partial exchange. I gave you an example of when it doesn't work. These are all the things I go through with your client as a QI. Wait a minute. Okay, here's the identification rules. I'm just going to skip to the form. All right, so here's an example of the ID notice that we send out. You have a choice of the 3-property rule, which allows you to identify 1 or more, up to 3 properties of any value with the intention to buy 1, 2, or all 3. So you would check the box that you're using the 3-property rule, and you would just simply list the address of the properties. It's very important: street number, street name, city and state. If there's a unit number, a unit number. You cannot identify, say somebody wants to buy a condo at 123 Main Street, Wilmington, Mass, at the Larkspur Lake condominiums, right? A 2-bedroom condo. No, that's as if you're buying, you can't do that. You have to be specific with the condo number. And if you leave the condo number off, and it's as if you're buying the whole building. So your clients need to know that they've got to be, and as a realtor, you should not fill out their identification notice. This is their taxes. This is their tax return. They need to fill out their own ID notice. I suggest that people, even though they have till day 45 to get it in, if their 45th day is a Friday night, Saturday, Sunday, Monday holiday, Friday holiday, get it in by maybe midday of the business day before their 45th day is up, because QIs go home. They're not around on the weekends. So if somebody identified 123 Larkspur Lake condominium and left, or 123 Main Street, Wilmington, Mass, and it's a condo, we come in Monday, their ID was due Friday, they sent it in Friday at 7 o'clock, we're not seeing it till Monday. And therefore, it's as if they're buying the whole building. It's an invalid ID, we can't fund for it. So it's very important that this is done properly. This is where the IRS doesn't mess around. Now, you're also able, under the 200% rule, and a lot of people buying DST property do this because the offerings in their portfolios may have multiple properties that they're going to own part of all of them. This allows you to identify 4 or more properties, but the value can't exceed more than 2 times the sales price, hence the 200% rule. It gets the definitions kind of convoluted. So 2 times the sales price. So somebody's selling for $500,000, that they can identify 4 or more properties, but the total value cannot be more than the 2 times 5. Total value can't be more than $1 million. with the intention to at least satisfy their exchange requirement of equal or greater in value. They don't have to buy all of them. They just want to buy equal. If they want to buy equal or greater value, they'll have a full deferral. So in this case, they would actually have to list the price of the property. It's either going to be the contract price or the listing price if they're not under contract. People that might be selling, say, in Cambridge, Mass, right, for $1.5 million may decide to go to Springfield and buy a bunch of multifamily properties because you can buy those for, under 300,000. You could identify several out there. Okay, so that's just an example. Also, if you're going to buy a DST property, you're identifying by percentage. And suppose Stacy and I, again, we can be sisters or not, doesn't make a difference. I'm selling my property for 500,000. She says, hey, Lynn, there's this property that's worth $1 million, and I'm just using easy numbers that I'd like to buy as well. You want to buy it with me. First of all, I have to retain a tax ownership that reports under my social because that's how I own my property. Stacy's going to have to, you can use whatever she wants. She can, use her own social, personal tax ID. She might have an LLC with her husband. It's a multi-member LLC at that point, even though they're married. So it's a regarded business entity. So it could be her business entity or it could be her. She'd be buying 50% on her own. Let's just say she's not exchanging. I would identify 50% of that street address because I'm going to own 50% of the building. I would then have to report 50% of the income and expenses, and she would report hers. So that's how that would work. The 95% rule, danger, Will Roger, dangers, for those of you that remember that show on a million years ago. If you identify 4 or more properties and exceeds the 200% rule, you have to be able to buy 95% of the property you identify or your entire exchange fails. You don't get partial credit. I will tell you, in the world we live in, this and how things are happening nowadays, this would be an impossible rule to use practically. So I wouldn't even look at it, and it's not your job to advise on what rule they use. Split treatment, and then I think this is our last slide. Owner-occupied multifamily properties, how do they work? Let's just say, you can read that on your own because we talked about a lot of when a 121 exclusion allows you, if you've lived in a property or part of a property 24 months out of 60, you're able to take the primary residence exclusion in your primary residence, okay? If you exceed the primary residence exclusion on the value of your property, realize your client under that tax code would have to pay taxes on the difference. So if you had a married couple with a $500,000 exclusion, but their capital gain was $750,000, they'd pay taxes on $250,000. All right, so now we have a multi. Let's just say this property sells. It's all 4 units. Let's just say they're all the same size. They don't have to be. All 4 units are the same size. They sell for $1,065,000. $65,000 is pretty close to the allowable cost of sale. All right, so this property is worth $1 million, divided into 4 equal parts because the CPA says that each property is 25%. All the units are the same size, same square footage. So each property is worth $250,000. So the value of the primary residence is worth $250,000. The other 3 rental units are worth $750,000. So that taxpayer can go off and purchase investment property for $750,000 or greater, or multiple properties. And then they can take the cash allocated to their primary resident unit at the closing table. Let's just say it was an all cash deal. They would walk away with $250,000 for the primary residence because, say, their mortgage was paid off. And then the $750,000 would come to API. Remember, we've taken out the allowable costs, would come to us for them to buy their next property. But just suppose there was a $400,000 mortgage on this property. What would the numbers look like? They'd have in their primary residence $150,000 in cash because the money the buyer brings in would be paying off $100,000 worth of the mortgage allocated to the primary. $450,000 would come to us on the primary residence unit side because $300,000 of the mortgage has $100,000 allotted, as $300,000 allotted to the rental units. Why is this important? Because you're using a split treatment transaction. CPA must be involved in split treatment transactions because these allocations need to be correct. Some units, some properties don't have something evenly spaced out like this. Let's just take the same example. Client decides they want to go live in one of the units of the next property they buy too. very important that the CPA is involved, because they don't have to go buy 3/4 of another property. They don't have to buy another 4-family. Let's just say they go, well, listen, I'm thinking about buying a duplex. In a perfect world, the duplex they're buying is worth $1.5 million. Both units are the same size, because then we know that the one unit they want to rent is going to be worth $750, right? And where they would live would be worth $750. But that's not how it works. So a QI can only fund for the value of the portion of the property that's going to be used as investment. So this is where the QI comes in, because they're going to have to put in personal cash for the allocated value of another owner of occupied property, if that's what they decide to do. So these are not last minute transactions. If your client's going from even a single family residential rental to a property that they want to live in and rent out part, or they're selling a multi to move into another multi themselves, we've got to have this conversation. Their CPA must be involved. This is really very important. But can you do it? Yes. Okay. It's all going to be based on allocations. Again, the QI can only fund for the investment portion of the property. They will need to put in personal cash for the part that they're going to live in. And the CPA is going to want to figure out the mortgage allocations and keep a record, because as you know, on a settlement statement, you can't show a mortgage allocation. So, and I'm going to ask for those percentages for our records. Okay. I'll let you read this on your own. Here's the due diligence you need to know when recommending a qualified intermediary, if you're going to. Things that people want to take a look at. Here's my contact information. I am available for questions. Any topic that you heard here that you want to know more about, please contact me. I'll be glad to send you what I have. And do we have a few minutes for questions, or did my time include the questions?
I have been answering some of them just based on, there were some questions that came through for some people that came on late, and I answered those. I also want to let everybody know that we did PDF this presentation, and I put a link to that PDF right in the chat box. So if you like everything you heard, or you have more questions, or you have a client that you think might qualify for a 1031 exchange, you can download the PDF in the link in the chat box, and in there you'll also have Lynne's contact information. Lynne, as always, I feel like next time, and I say this every single time, we need to do like a 2-hour at least, because there's so much.
You can get it. I'm able to teach for CE credit.
Yes.
So if there's able to, I usually go, I go through usually a real estate school. I don't know if you have one.
Yes,
but
we do.
I'm able to, if you do, I'm able to teach for 2 hours of CE. I have.
Okay, awesome. That'll be the next one. We'll plan on something that we can do a 2-hour and do like a,
yeah, because the cool thing is when I was talking about intent to hold, I've got a couple of cases to go through, which is really interesting. I also have a chart that breaks out all the math that talks about what the capital gains taxes would look like and things like that. Because I gave you an overview today, even though we were here for a little over an hour. Yeah, there's it bears repeating, especially because many of your agents either own investment property, family members do, or they want to get started. And using, if you're going to invest in real estate, knowing about 1031 up front is really important, and especially how you're going to hold title and report taxes. One more thing, if you're thinking about it from my side, when I see deals come across the table, if you're going to invest in real estate with somebody else and you're going to be buying for the first time in a business entity, I call it a business prenup. Figure out an exit strategy before you even buy the first piece. Because when you're married in a business entity to other people and somebody has an issue where they've got to get out of the transaction, it can mess it up for everybody else. So you want to meet and look for okay, so somebody needs to force the sale because of whatever, and we don't have the capital to buy them out. All we can do is sell the property. There could be a mess. So you want to have some you want to go through the things that can go wrong on the back end and have a plan to fix it so that everybody doesn't get burned paying taxes.
Yes. What's really interesting too is we just did a class a couple of weeks ago on Airbnb, And it's interesting because I never really thought about how a 1031 exchange would play into, there's just so many clients now buying properties that are vacation rental properties. So.
Yeah. And in the class, we can talk about, okay, so I have this vacation property for 24 months. When can I move in?
Yes.
When can I change into a second home? The CE class will spend, I've got information in there on that, but I've got tons of printed material on that too.
Okay,
It's
awesome.
not, remember, none of this is a DIY project.
Yes.
It's not.
Thank you so much, as always, Lynn. Great information, and we'll be in touch about our next program.
Thank you, everyone, and enjoy this wonderful, beautiful, magical season that we have coming up. However you celebrate, travel. I wish everyone the best and a joyous new year if we're not in touch before. I can't believe starting tomorrow.
I know.
We're
Thanks,
in that
Lynn.
last push. Thank you, everybody.
Bye.
Appreciate your time. Thank you, Stacy. And Sergio back there.